Okay, good evening, everyone. I'm Sheetal Vilkar, founder director of UBAC and VP East, Naredko Mahi. Warm welcome to Naredko Mahi's Upskilling Series 3. We are happy to see so many enthusiastic faces here today to explore the background and basics of GST in real estate. It's our pleasure to introduce our esteemed speaker for today's session, CA Venugopal Gila, a renowned chartered accountant, GST expert and founder partner at Mrs. Venu and Vinay. With an impressive academic record, including an All India 45th rank in CA final, he is a certified information systems auditor and has completed various specialized courses from ICAI and IIM Bangalore. A prolific speaker, author, and trainer, Venugopal sir has authored industry-specific handbooks on GST, contributed to ICAI's technical guide on GST audit, and developed innovative Excel-based utilities on GST. He has played a key role in shaping e-invoicing standards with GST and NIC, with expertise spanning internal controls, ERP implementation, management consultancy, and coding. Venugopal sir is here to share his invaluable insights on GST in real estate. So please join me in welcoming him. So please put welcome in chat box. And now over to you, sir.
Thank you for the warm welcome. And I'm very happy to be here, and especially very happy to see women in the real estate sector. And that is an area where people doesn't want to be in. And very happy Naredko Mahi is hosting sessions for upskilling of the people. And a warm welcome to all the members who are present here. Today we are talking about GST in a real estate sector. We are going to talk basics of GST, especially on the real estate sector. So I request members, attendees, to put your questions in the chat box. Whenever you have a question, put up in the chat. At appropriate time, we will take up the question. In case if it's not clear, maybe we will see how you can unmute and take up the question also. And this session is being recorded so that you can also watch it at a later point in time. Let me start sharing my screen. Yeah. Okay. So hope the screen is visible. Please put it as yes in the chat if it's visible to you. Is the screen visible? Yes, I've got confirmations that the screen is visible. So that means I'm clearly audible. Now, we are aware that real estate is a very wide term. And when we say real estate, what comes to people is a house property. Now, the property is one aspect of the real estate. But when it comes to the taxation, there are multi-facets of the taxation for real estate. Someone constructs the apartment. It's a service. Post-construction, someone is renting it out. Another service. During the course of construction, someone is selling steel, cement, and everything. This is supply of goods. Someone is entering into a joint venture to build, develop together. They are giving some development rights. We're all talking about construction of a house, commercial complex. Is real estate only that? The answer is no. Real estate would continue to include development of roads, bridges, canals. It would include all works contract, exterior works. So the real estate is a wide terminology which we have to consider. What are we going to cover today? Are we looking at all? The answer is no. We are going to look at the tax rates, the key aspects, which is the tax rates, different types of projects, and I will walk you through a practical example. We will take an Excel sheet and understand the taxation. Some of you might be in procurement, some of you might be in legal, some of you are in marketing, some of you are developers by yourself. You might be in different facets of the whole of the chain in the real estate. So it's very essential that when you actually talk to people about the real estate, you will have to necessarily be present to what is the taxation I am talking about? What is the cost addition that I am going to incur? These are the other aspects that one needs to be aware of. चलो हम शुरू करते हैं. Let's start with the rate of tax, which all of us or most of us are aware. So the rate of tax which is applicable for the GST. Please look at the chart here. Real estate in GST has undergone two different eras. 1st July 2017 till 31st March 2019, and from 1st April 2019 to the subsequent. So in 2024, I am talking about the applicability of the tax as on today. We all know the rate of tax in real estate is 5%. That is what we talk, right? So how does that come as 5%? Is 5% rate of tax? That is something which we will see. Projects can be in multiple things. The word terminology used is REP, real estate project. You will find another terminology called RREP. So anyone who are connected to RERA, you would be hearing these terms: project, real estate project. GST has brought in another thing called RREP, residential real estate project. Now, anything which is residential is RREP. Other than residential is this real estate projects. Okay. Now, something which a project in a real estate project, a residential, the residential, it could be 100% affordable housing project. 100% affordable housing project. The rate of tax is 1%. Other than affordable housing project, the rate of tax is 5%. Commercial, if it is a commercial in an RREP, if it is a commercial in RREP, the rate of tax is 5%. The rate of tax is 5%. So in an REP, both affordable and other than affordable is same. But there is a small distinction of commercial in an REP project. In an REP project, the commercial is going to be at 12%. The rate of tax in commercial is going to be little 12%. And these rates are definitely going to be little confusing. I'll tell you why. Because there is no levy of GST on land. There is a levy of only GST on construction service. Now, how does this rates have come? This 1%, 5%, whichever we are talking, the rate of tax in GST, we are talking 1%, 5%, 12%. How did it come? Actually, this is not the rate of tax. The rate of tax is 1.5%, 7.5%, and 18%. The rate of tax is 1.5%, 7.5%, and 18%. You know, when an apartment is sold, what is being sold along with this apartment is underlying undivided share of the land. There is an underlying undivided share of the land. So bundled together, let's say you are selling this project for 1 crore. Let's say you are selling this apartment for 1 crore. GST presumes construction of this, the building related value is 2/3. The 2/3 of this is out of 1 crore. 2/3 is deemed as building, and the beneath land, the undivided share, is deemed as 1/3. मान लीजिए you have entered two separate agreements. One agreement for construction and sale, agreement for sale of undivided land. Let's say you said 60 lakhs for land, 40 lakhs for construction, or vice versa. 60 lakhs for construction, 40 lakhs for land. It could be anything. It really doesn't matter. In GST, when it comes, when an apartment is sold, GST brought in a deeming provision. What's the deeming provision? The provision says that 2/3 is to be treated as building value, 1/3 has to be treated as land value. Now, on land, there is no GST. When you sell land, there is no GST. So for 1/3 portion, GST is not applicable. GST is applicable only on 2/3 portion. GST is applicable on only on 2/3 portion. So for the 2/3 portion, the rate of tax is 1.5%. Now, 1.5 multiplied by 2/3 is when we are looking at this, when we are looking at this as 1%. So now if you look at the diagram, look at carefully. If you look at it, when we say affordable housing, when I am taxing an affordable housing project, if say I am selling the apartment at 40 lakhs, the GST applicable on it is 40,000 rupees. How did I get it? 40 lakhs into 2/3 into 1.5%. 40 lakhs into 2/3 into 1.5% is affordable, which is otherwise to be treated as 1%. A residential house other than affordable, a residential house other than affordable is 7.5% at the rate of 2/3. It's 7.5% at the rate of 2/3. And lastly, if it is selling a commercial project, rate of tax we say 12%. However, it has an input tax credit. I'll come about input tax credit in a while. The rate of tax is 12%. Effectively, it is 18% into 2/3. Now, let me take with an example. Let me take an example and let's do. Let me share an Excel file. So let's look at a small example. Value of the apartment. Affordable other than affordable commercial. Let's say this is 40 lakhs. And let's say this is a 1 crore property. and commercial, let us say 1.5 crore property. By the way, is the Excel screen visible to you?
No, I was about to tell you that. Please share your Excel screen.
Is this visible now?
Yes.
Ah. So, all right. So let's say the value of apartment. Now, commercial, are you saying apartment? Yeah. So the words now is apartment means it's a block, chamber, everything. Now, the land value is deemed as 1/3. Building value is deemed as 2/3. So the land of this is 1/3.
So can you make this full screen? So will be more visible.
Yeah. This is not showing us full screen. I have zoomed it.
Now it is visible, but otherwise you can just in Excel, you can go to full screen. That way also you can do. If it is possible, do it. Otherwise, it's okay.
Is the screen Excel in full visible to you? No.
Now it is visible.
Yeah. All right. So now this 40 lakhs has been split as land 1/3 and building 2/3. And for the other than affordable, for 1 crore, it becomes 33 lakhs and 66 lakhs, 50 lakhs and 1 crore for commercial. All right. So rate of tax here is 1.5%. This is 7.5%. This is 18%. So which means the GST is building multiplied by this. So if you can see, the GST is 40,000, 5 lakhs and 18 lakhs. For the common man, when you are making a sale, if you try to tell that the GST is calculated in this way, I will reduce 2/3 and on the balance I'll pay at 1.5, 7.5, 18, they might not get it. They will be little confused. So what is the ease of doing for them? I can tell them, for a common man, when I'm making a sale, I will tell them that GST, GST for the apartment in an affordable project, it is 1%. Other than affordable project, it is 5%. And commercial, I will say it is 12%. Now, if you look at it, for the understanding of the common man, 1% is calculated on 40 lakhs, 5% calculated on a crore, 12% calculated on 1.5 crore. This is how we tell to a common man. But honestly, this is not the rate of tax. This is not the rate of tax. The rate of tax is this. The computation and filing of returns happen in this manner. It is computed and the returns are filed in this manner. Is this clear to you all?
Yes, sir.
Any questions to anyone at this point? You can put your questions on the screen. Any questions?
I don't see any questions here, so.
All right. So now let's understand the difference between affordable housing and other than affordable housing. Why does I say this is how at what is that differentiate a property as affordable and something other than affordable? I would like to ask participants, what do you think? What differentiate and what makes a house as affordable and something as other than affordable? Anyone, any guess? Any, what's the answer? What is an affordable house and what is other than affordable house? You can put your question answer in the chat. What do you think is affordable and other than affordable? Okay. Low income group housing cost 45 lakhs. Very good. Now, if the value of the property is less than or equal to 45 lakhs, it is called as affordable. If the value of the property is more than 45 lakhs, then it is called as other than affordable house. Not just that. Now, getting a house property with a value around 45 lakhs in, say, Delhi, Bangalore, metros, Chennai, Hyderabad, Delhi, Bombay would be a little difficult, but other places it will be. So, is this the value alone? The answer is no. Area is also there. Perfect. What's the area? The area of the property in an affordable housing should be less than 60 square meters in metros and less than 90 square meters in other cities. So, in case of an other than affordable housing, that means in metros, the apartment size is more than 60 square meters, non-metros apartment size is more than 90 square meters. Then it would be treated as other than affordable. Now, for the purpose of understanding it, let us take an example. Let's put it. So let us take one small couple of example and understand this. Now, I am saying the city is metro city and my apartment area, which I have given to the customer, all right, I have given them a 45 square meters and the price is in lakhs. All right, the price in lakhs, I'm giving it as 50 lakhs. Whether it would be an affordable housing or other than affordable housing. Situation one, what do you think? Is this an affordable housing or other than affordable housing? Yeah. So this cannot be an affordable housing because the price is more than 50 lakhs. All right. So this is other than affordable housing. I'll put as OH. Now let's look at another situation. I'll say metro. My apartment size is this. My price here is 42 lakhs. What would this be? What would be the situation two? What would be the apartment classification? So the rate of tax here would be 5%. In the situation two, is it affordable housing or other than affordable housing? Yeah, this is affordable housing, and which means the rate of tax is 1%. Let's continue it. The metro. The area is 75 square meters and 44 lakhs. So I'm just closer to outskirts of the thing. So the price is less than 44 lakhs. In situation three, is it affordable housing or other than affordable housing? Is this AH or OAH? Yeah. So even this is OH and hence the tax is 5%. Though it is less than 45 lakhs, but my apartment area is 75 lakhs. Let's look at if the same is in non-metropolitan city. So if it is non-metropolitan city, what would be your answer for question number 4? For question number 4, what do you think would be the rate of tax? For question number 4, what would be the rate of tax? So the question number 4, if you see, the area is 75 square meters, more than 60 square meters. So Vyankush is saying 5%, Gaurav is saying 1%. Now, if it is non-metro, the limit I have to look at is 90 square meter. Yes, this is less than 90. Price less than 45. Yes, this is less than 45. So this would be affordable housing and it would be 1%. It would be 1%. Now, last situation, it's a non-metro project. It's a non-metro project and 80 square meter and I am charging 50 lakhs. What is the rate of tax? Would it be an affordable housing or other than affordable housing? I am well below 90 square meters. Yeah. So this, the moment I cross to 45 lakhs, it cannot be treated as affordable. It does not remain affordable. So it would be treated as other than affordable housing. So the rate of tax would be 5%. The rate of tax would be 5%. So are we clear with this? The affordable housing and other than affordable housing. So is this screen that we have discussed on the rate of tax? I think everyone are clear. If you are clear with the rate of tax, can we move to the next subject? If you are clear, please put it as yes in the chat. Perfect. Now, we said the price is 45 lakhs. We said the price is 45 lakhs. What does this 45 lakh means? What does this 45 lakhs means? Let's understand now. What do you mean by price 45 lakhs? Including stamp duty, excluding stamp duty, car park, floor rise charges, basic. So what are all the things 45 lakhs should include? What are the things? Please redisplay earlier screen. This is the earlier screen. Ambujaji, is this what you are asking? Yeah, if you have taken screenshot, well and good. We will move to understanding what does this price. So generally, tell me in an apartment, when you go and buy an apartment to a customer, what are all the things you are selling? You will say basic, let's say 5,000 rupees per SFT. You will say floor rise charges. Okay, 1 lakh extra for each 3 floors. Car park, 2 lakhs per car. Let's say east facing, you will say 1 lakh extra. Second balcony, 2.5 lakhs. All right. Very good. I got one message from Shambhugiji. PLC, EDC, IDC. So can you please describe? I'm sure some of you, all those who are in marketing will be well aware. but those might not be knowing. So can you describe all this? PLC is the preferential location charges. Now, for then extra, there is a stamp duty. You will charge, let's say 8%. You will say legal, some 25,000. You will say uh, uh, it could be something, uh, some charges, some doesn't charge, but the common area and external internal beautification, you will be charging, let's say, some 1,50,000. You charged all this to the customer. For a moment, let's think. These are the things you are charging. Not necessarily. I've just given a hypothetically different things. So what does this 45 lakhs would mean? And you all know, whatever is the price that is so told to the end customer, aapne agar, let us say someone is taking 600 square feet apartment. So 600 into 5,000, it is 30 lakhs. But by the time he registers and he makes all the payment, easily it is up by another 25%. So it will become 40 lakhs, right? Now, tell me, for the purpose of determining GST, do I need to consider only this? Do I need to consider only this? Or do I need to consider all of this? Do I have to, what are all the things I have to consider? Do I have to consider all, or do I have to ignore some? Anyone has any view, any answer? Stamp duty has to be ignored. Let's ignore that. Basic FRC, PLC, and second BAL. Gauravji, what do you mean by the last one? Second BAL, I don't know. Ambuja ji is saying except stamp duty. Perfect. So the answer is except stamp duty, whatever you are collecting as a part of the sale of an apartment, as a part of sale apartment. Now, apart from this, let us say water and KEB deposit. Let's say 2 lakhs. Let's say common area maintenance post construction. Oh, see, a builder maintains for 1.5 years, so he has just collected 1 lakh rupees. Now, clubhouse membership. Let's say these are the other charges that have been collected. Now, these are not including in your 45 lakhs because these are not forming part in sale of an apartment. Like water and KEB deposit is something, is a refundable thing. It's in your name. So builder is collecting and parking and putting it in your name. Common area post OC, that means building is completed, only that it has come. The clubhouse, the membership fees is, which is an optional item. So it is something which is sold independent. If you pay 50,000 and pay the maintenance, you'll be part of the clubhouse. Otherwise, you will not be part of the thing. So 45 lakhs, for computation of 45 lakhs, what you are seeing on the left hand side with the tick mark, only that would be included in deciding what is affordable, what is other than affordable. अगर ये चीज जो टिक मार्क है, if the sum total of that is exceeding 45 lakhs, then it will not be an affordable housing. The rate of tax is going to be 5%. So is this screen and the slide clear to you all? Perfect. Now, given that we understood the basic structure of the taxation and the taxability, let us move on the joint development that happens. Let's move on the joint development. So I'm switching from Excel to the PowerPoint. Is the PowerPoint visible? Yes. Now, so in a joint development agreement, I am starting with an area sharing residential agreement. I am starting with an area sharing residential arrangement. So, what is a joint development agreement? A joint development agreement, it is property and apartment jointly developed by the landowner and the builder. How does it happen? Landowner says that, see, I have no ability to build the house, go to the government, get the sanctions, complete the project, tell the end customer, or I don't even have money to do that. All that I have is a piece of land. So all that I have is piece of land. Developer says he can either purchase the land and construct for himself. The moment he is purchasing the land, the money is blocked. Rather, he would say that on your land, instead of me buying, I will construct and give you some amount of the constructed units. I'll give you some amount of the constructed units. So the developer says that there is a right in the land called development right. There's a right in the land called development right. Now, whenever land is one natural resources, if you say that you are owning a natural resource, you have bundle of rights. What are the bundle of the rights? Since you have land, you can build something on it. You can dig and mine something in it. You can let it out, but they're all conditional rights. Just because land is yours doesn't mean you can construct how much ever square feet you want. Doesn't mean that the land is yours. You cannot say, I will do a deep mining and I will dig some 50 feet out of this. You can't say that. You can't say my land, I will let it out to a terrorist or Naxals or anyone. You can't say. They're all conditional rights. The ownership of the land comes with bundle of the rights, and those are all conditional rights. In a joint development agreement, you are cutting one right, saying that development right. Landowner is saying that I am no longer developing the land. My right to develop of this land, I am relinquishing. I am giving it off. Giving it off to whom? To the builder. Builder, you keep the development right. What does the builder do? On this land, builder constructs an apartment. Builder constructs an apartment. Now, this apartment which is constructed, does it exclusively belongs to the builder? Answer is no. Builder says, since this is an area sharing arrangement, he says, some piece of an apartment you own, some portion of the apartments I would own. So they will call some area sharing arrangement. Generally, between 30 to 40% of the constructed units are given to the landowner. Between 60 to 70% of the constructed units are retained by the builder. Good. What does the builder do? Builder has no intention to keep this. He will find a buyer. Before the occupancy certificate, he will sell off the units. There could be a situation where some inventory would remain unsold on the date of OC. Possible. What is the landowner doing? Landowner, the units he has received, even he is selling. Some he may retain for his own use, or he may give it to his family member. his son, daughter. So he can write one apartment in their name and let it out and keep it. Choice is his. But practically, this is what happens, right? Now let's understand the GST aspect of it, the taxation of it. How does the taxation work in an area sharing? Now, before I get into the taxation, are you all clear with the transactions that happen in an area sharing between the landowner, developer, and everything? Are we clear so far on the screen? Perfect. Now let's look into the taxation. First aspect is developer. He has sold some units. Landowner has received some units. How did he receive some units? Developer has sold. I am repeating this point. Developer has sold the units to the landowner. You may say, where is the question of sale? It is, isn't it the arrangement? But under GST, this is called barter. Landowner has sold the development right. Builder has sold the apartments to the landowner. So this is called supply of construction services. Supply of construction services. The developer has to pay GST as if he has sold to the landowner. Developer has to pay GST as if he has sold to the landowner. Now the question that comes is, at what value, at what rate of tax? Now, since it has been sold, whatever is the value on the date of the joint development agreement, because construction होने में at least 2-3 साल लग जाएंगे. So on the date I entered the joint development agreement, remember in the Excel, let's look at that Excel. This is what you are offering to the end customer. So if you look at it generally on launch date, you will sell it at 5,000. Okay. First year, you will sell it at 5,500. Second year, you will sell it at, let's say, 6,000. Now, when the project has received OC, on the OC date, because it is like a ready to move in project, you will sell it at 7,000 per square feet. Now, when are the units handed over to the landowner? The units are handed over to the landowner on the OC date. But for the purpose of GST, I will have to look at the value as on the launch date, because on the launch date, I have entered into a joint development arrangement saying that I will develop, I will give you 40 units, I will keep 60 units. So the value is on the date of joint development agreement. Now, can you tell me what would be the rate of tax which the developer has to pay to the government for the units sold to the landowner? Would it be 5%, 1%, 18%, 12%? What do you think will be the rate of tax? Remember in the earlier screen, we have seen different rates of taxes. We have different rates of taxes. So for the units sold by the developer to the landowner, what would be the rate of tax? Very good. Yankushji is saying 5%. Any other views? Others, it's okay. Even if it is wrong answer, that's fine. Only when you tell a wrong answer, you'll be more clear that galat kaise hua, kyun hua. What do you think the rate of tax would be? See, the rate of tax is determined by the value of the supply. Rate of tax is determined by the value of supply. Exactly, it could be 5% or 1% depending on the classification. How do I classify? It's a barter. Developer is not physically receiving the money. He is receiving virtually or notionally. Landowner has given him development right. Developer has given apartments. So value of that apartment on the joint development, that is the launch date. On the launch date, is the value of this apartment is less than 45 lakhs or not, is the first question. Second, each area of the unit that has been given, is it less than 60 or 90 square meters accordingly, depending on that. You have to look at the classification of these apartments on the date of JD. On the date of JD. For example, let's say all the units are less than 60 square meter. But on the launch date, I have sold at, let's put a values to this, okay. Let's say 600 is SFT into this plus some 5 lakhs. I am all other car park, everything I am charging this. Now, if you look at it, by the time the project reached the OC, no longer this would be called as an affordable house. By the time the project reached OC, this is not an affordable housing. But for the purpose of GST, units that are given to the landowner will be treated as an affordable housing, and the tax rate would be 1%. So now we understood the taxation of the first one, which is developer has to pay as if it is his sold. Now let's look at the second one. Second one is he has sold before the OC to end customers. So same as usual, 5% or 1%, but it will not be any ITC with him. Now there are units which have been retained by him. The moment it becomes an immovable property, a land and building, it is completed. If a completed house is being sold, no GST. You all have to know this. You all have to know this very clearly. If a completed house is sold, there will not be a GST. So for this sold after thing, there will not be any GST. Any number, if a customer is coming into contract and OC is received, no GST. However, government has said that I will charge a development right taxation under reverse charge. Now, what is reverse charge and what is forward charge? Imagine you're going to a shop and you're buying, let's say, a mobile phone. Now, when you buy the phone, let's say value of the phone is 1 lakh and you're paid 18,000 rupees. Who is paying GST to the government? Do you think there's a shopkeeper who is paying? Answer is no. You are the one. You are paying to the shopkeeper. He is further paying to the government. So he can be treated as a honorary tax collector. Government doesn't pay him any salary, but he is collecting the tax from you and paying to the government. Who is paying GST? You are paying GST. So it's called forward charge. It's called forward charge. So the supplier is collecting from the customer and paying to the government. What is a reverse charge? In a reverse charge, supplier says, I don't know. Buyer is supposed to pay to the government directly. So imagine that example of phone. You buy 1 lakh phone, you pay 1 lakh to the shopkeeper, 18,000 to the government directly. This is called reverse charge. In a reverse way, the tax charge is made on you. Similarly, development right is sold by the landowner to the developer. Landowner has sold the development right to the developer, but the government will say that the developer has to pay under reverse charge. So for the unsold units, the developer will be paying under reverse charge. Again, there is no input tax credit for him. Now, for the units that has been sold to the landowner, the units that have been sold to the landowner, there was a GST levied. This GST, which is levied, will become as an input tax credit to the landowner. landowner is eligible to take input tax credit. So when a landowner is selling the units before the occupancy certificate, so he will also pay 5%. Now you may ask, builder has built, given it to the landowner, government got GST, landowner is selling again, government wants GST on it. Isn't it double taxation? The answer is, it is not a double taxation because landowner is now eligible for input tax credit. Landowner is eligible for input tax credit. For the units he retained with him, which is unsold, he will be reversing the input tax credit. Let me take an example in the Excel. Let me move to the Excel. So we said, let me clear this. We said that value on JD date. So the value on JD date here is 35 lakhs. All right. So let's do the GST on it. So builder pay 1% for this transaction. Builder pays 1% for this transaction. That means builder pays 35 lakhs into 1%. 35,000. Now, landowner, he is selling to end customer. He bought a customer and he sold it to that customer. He is selling it at what price? Let's say 40 lakhs. Let's say he's selling it at 40 lakhs. Now, he is also have to pay GST at 1%. That means he has to pay a GST of 40,000 to the government, but he will not pay 40,000 to the government. From the customers, he will be collecting 40 lakh 10,000, 40,000. But he will say, since he has an ITC of 35,000 rupees, he will pay it in cash to the government. He will pay in cash to the government only 5,000 rupees. 40 minus 35, 5,000 rupees. So the value addition is what the government is getting. A value addition is what government is getting. So hope this screen is now clear to you all. You understood the taxation. Just take a look. If you did not understand, please put your question in the chat. Let me take up the question. Let me open the chat. In RCM, recipient directly pay taxes to the government. Please repeat. I don't know which part of it. Yeah. Is this clear to you all? So can I move to the next type of levy? Perfect. Let's move to a revenue sharing arrangements. What we have seen is area sharing. We will now move to revenue sharing. What is a revenue sharing arrangement? See, landowner says that I have no ability to get approval from the government. I don't know where to buy material, how to construct. I don't know architect. I don't have ability to sell. That is why I am getting into a joint development agreement. In an area sharing, the landowner says, look, I don't even want the apartments. What will I do? How will I sell? I don't know. You can अच्छा market कर सकते हो. You can easily sell. I will not be able to sell. Please keep these apartments with you. I don't need the apartment. You only retain. All apartment is yours. But every rupee that you are getting from the customer, pay me 30 paise, pay me 40 paise. So the landowner is saying that you keep the apartment, pay me 30, 40 paise. Now what happens? The developer says, all right, that's fine. So I will sell these units to the end customer. whenever I am making a sale, whatever the money I am getting, a portion of money I will be giving it to you. A portion of money I will be giving it to you. Even the units which are left on OC, we are married together till the project is complete. I will be selling it even after the OC. Even for this, I will be paying you for each rupee I am selling. I will be paying you. So today I am selling at 5,000. Tomorrow I will sell at 7,000. Whenever I sell at whatever be the price, 30 paise of the item which I am selling, I will give it to you. This is the arrangement. This is the arrangement. This is how revenue sharing happens. So let's understand the taxation. But before I go into the taxation, is revenue sharing arrangements clear to you? Is revenue sharing arrangements clear? Gaurav Goyalji is asking why value of launch date is taken for landowner development right? The answer is the law says since you have entered the agreement on the project launch date, GST is supply or agree to supply. Supply happened then, so value of then has to be taken. That's the GST understanding. Yeah. All right. So now let's go to the revenue sharing taxation. Firstly, for the units which have been retained, otherwise part of the landowner retained by the builder, since it has not been sold, so there is no question of construction services, no question of forward charge GST to the landowner. All the units are with the developer, nothing is sold to the landowner, hence there will not be any levy. Second, the units which are sold before OC, you will as usual pay forward charge without ITC. For the units which are not sold, remember the development right taxation, that will still continue. The development right has to be paid by the builder on a reverse charge basis. Now, for the money that he is landowner is getting out of the pre-OC sales, see, this is a transaction in money. A tax paid money is appropriated, hence there will not be any GST. A tax paid money is appropriated, hence there will not be any GST for this transaction. For the units which are sold after OC, even this, the taxes are paid by way of development right, there will not be any GST. So between revenue share and area share, are you clear? Are you clear between revenue share and area share? Yankushji, you have a question in area share, please ask. Maybe if you can unmute yourself, is it possible? Can the participant unmute themselves and ask?
Bhavni, what are the settings you're there?
I can do that.
Yeah.
Yeah, can you allow Yankush? So some units are remaining with the developer. Yes, Ankushji. So even if it is remained, okay, what is the question? All right. So what is GST rate tax rate different for basic PLC IDC? Ambuja Tomarji, you are taking me half an hour back. GST, when we say 45 lakhs, 45 lakhs includes everything. So let me go back to the Excel. We said everything, all this included in that 45 lakhs. Floor raise, EDC, PDC, whatever the name you call, IDC, PLC, whatever the name you call, any charge is included in 45 lakhs. Rate of tax is the same. Okay. So now I will take the example of GST applicability in an area sharing. We will take with a small example. Okay. Let's say area 10,000 SFT. Let me just. So let's say area is 10,000 SFT. So I am building 100 apartments. Let's say area 1 lakh SFT. We'll take it 1 lakh SFT. So I'm building apartments. So each apartment is 1,000 SFT. Each apartment is 1,000 SFT. Now let's say on project launch date, okay, project launch date, I am rate for SFT, I am selling it at, we'll keep it as 10,000 for the ease of understanding. And year 2, I am selling it at 10,000, I will sell it as 11,000. Year OC date. On OC date, let's say I'm selling it at 12,000. So which means apartment price in crores. So when the project was launched, this apartment, what was the price of this apartment when project is launched? It's 1 crore. Okay, it's a 1 crore apartment. And after year 1, it became after it became at 1.1 crore. By the time the project OC has come, it became 1.2 crores. It became 1.2 crores. Let us say in terms of my sharing, okay, to landowner, I will say 40 units. To builder, I say 60 units. To builder, I will say 60 units. Okay. Now, let's also put sold before OC. Let's say out of 40, the landowner has sold 35 units before OC. On OC date, let's say he has 5 units. And builder, let's say he has sold 50 units before OC and 10 units are remaining unsold. So these are the total units, right? These are the total units. Now let's look at one by one. So one, the developer sold to customers. Developer sold to the customers. See, he would have sold some for 1 crore rupee, some he would have sold for 1.1, some he would have sold for 1.2. Average, let us say he has sold at 1.1. So what is the sale value of this? How many the developer has sold? In this example, can you all tell me how many the developer has sold? He has sold 50. So for this 50 units, he sold at 1.1. The sale value is 55 crores. The GST applicable on this, he has to pay a GST of 2 crore 75 lakhs to the government. He has to pay 2 crore 75 lakhs to the government. Is this clear? The sale by the developer to the end customer, he has to pay GST of 2.7 crores. Is this clear? The first one? All right. Now, what is the do? Developer sold to landowner. Developer has sold to the landowner. How many units he has sold to the landowner? How many units developer has sold to the landowner? 35 units. Unfortunately, we have taken 1 crore. value also 35. This 35 units, by the way, 35 is the wrong answer. There is nothing called during construction. The developer has sold 40 units to the landowner. Developer has sold 40 units to the landowner. Now, landowner, he is selling or not selling, that's a different. I'm only looking at the developer. Developer sold 40 units. Each of this is valuing 1 crore. So, the developer has sold 40 crores worth material to the landowner. 40 crores worth material to the landowner. So, even here, the developer has to pay GST at the rate of 5%, which is 2 crores. GST at the rate of 5%, which is 2 crores. Is this clear? Developer sold to the landowner. Now, there is something landowner has sold. Landowner sold development right to developer. Developer has to pay under RCM. Developer has to pay under RCM. So what is this development right value? What is the sale value of the development right? Landowner has got 40 units. Value of the 40 units is this. Value of the 40 units is 40 crores. All right. So this 40 crores, if you look at the example, in the screen, if you can see here, development right, we are only telling the development right has to be paid for the unsold portion only. Development right has to be paid only for the unsold portion. So in the current example, if we have to look at in the current example, this 40 crores is for the total portion. So for the unsold portion, I have to look at the unsold portion, so the unsold portion, I will say 40 into the unsold portion of the builder is 10 divided by the total 100 apartments. Total 100 apartments. That means this is 4 crores is the unsold. And by the way, GST on the development right is 18%. It is supply of service. So GST payable is 4 into 18%. So at 72 lakhs, he has to pay. Here, government has given a relaxation. It said minimum of option 1 or option 2. The option 2 is unsold value. The unsold value of the units 10 into 1.2, it is 12 crores. The GST at 5%. If this have to be sold at 5%, government would have got 60 lakhs. Government would have got 60 lakhs. So the GST applicable on this is minimum of this. So the development right taxation is minimum of 72 lakhs or 60 lakhs. So the developer has to pay a development right taxes of total amount developer has to pay to the government is how much? He has to pay 2.75 plus 2 plus 60. 5.35 lakhs is what the developer has to pay to the government. Is this example clear? Anyone, any doubt? Yeah, landowner can claim ITC. We will come to the landowner taxation in a while. I'm enjoying my tea along with this. Hope you can have your tea too. Can we move to the landowner taxation, please? Is it okay? Are we clear? So the builder is going to pay 5,35,000 to the government. Now I'll move to the landowner. Landowner has ITC per unit. How much? He has received 60 lakhs. Landowner has ITC of how much? 60 lakhs. Anyone, any guess? Any guess, any answer? How much is the ITC landowner is having? All right. Landowner has received a GST of 2 crores. Number of units, he has received 40 units. So per unit, he has an ITC of 5 lakh rupees. ITC per unit. ITC per unit is 5 lakh rupees. Now, he has sold before OC. He has sold how many? 35 units. So his sales will be 35 units. Let's say, let's take he has sold at 1.1. His sales is 35. So the GST applicable is 38 into 0.5. Sorry, into 5% into 10. He has a GST liability of 19 lakh, sorry, 1 crore 92 lakh 50,000 and 1 crore 92 lakh 50,000. He has an ITC. He has an ITC 5 lakh per unit. So 5 lakh per unit into he has sold 35 units. He has an ITC of 1 crore 75 lakhs. So he has to pay in cash. He has to pay in cash 17 lakh 50,000. So the liability of the developer or the landowner is 17 lakh 50,000. The liability of the builder is 5 crore 35 lakh in this project. So are we clear? By the way, what's the total value of this project? The total value of the project, even if I'm taking 100 units at an average sale price, 100 units sold at 1.1. So 110 crore project and GST 5% on this. $5.5 and look at what government has got. Look at this. So it's a simple math. It's like a common understanding. This is a simple math. All right. 110 5.5% is this. However, the government has got in like a complicated structure. If you see on the right side of the screen, 1, 2, 3, 4, 5 different things, and it has come. But in a nutshell, 110 crores, 5.5 crore government has to get, it has got it in all these different methods. So that is why people say GST in real estate is complicated. Yeah, it appears to be complicated at the beginning, but as we do it, it's like pretty simple. So any questions to anything? Very good. Yankushi is asking, why can't landowner take input of all that was eligible on the date of ITC? But the government has put a condition, look, this is like you're trading. So you're trading 35 units, you will get ITC of 35 units only. You will not get ITC of 40 units. That's what the government condition is. Why developer is paying GST on 5 units given to the landowner after OC? Gaurav ji, the landowner is getting 40 units. By the way, please note, after OC only all the units will be registered, whether it is in the name of landowner, end customer. So no unit will be registering before OC. That doesn't mean the sales are happening after OC. If the agreement is received, if the first receipt from the customer is before OC, that means the entire value is sold. मान लीजिए in this 1 crore project, 5 lakhs is received before OC, 95 lakhs is received after OC. You can't say that no GST on 95 lakhs. You have sold the unit for the entire 1 crore rupees, even though you did not receive. By the time of OC, the builder has to pay 5 lakhs to it. Does this answer your question, Gauravji? Gaurav Goyalji? Okay. Any questions to anyone? Are we clear? Are we clear? At least some 4-5 people say yes, that will give me happy that okay, इतना complicated math करने के बाद चलो लोग कुछ किसको समझ में आया. Can you repeat the second part of the landowner? Let's look at landowner. Landowner has 2 crore ITC. He received 2 crore ITC for 40 units. So the ITC he is having per unit is 5 lakh rupees. Now he has sold 35 units before OC. That means his total collections from the customer is 38 crore 50 lakhs. I'm just going with an assumption that he has sold at 1 crore 10 lakhs. It could be 120, whatever. That's just a derivative. All right. So now 38 crores के ऊपर 5% GST at 5% on 38 crores is 1 crore 92 lakhs. This is ideally he has to pay to the government. Now it becomes like a double taxation. Developer has already paid. How much developer has paid? Developer has paid 1 crore 75 lakhs. So that 1 crore 75 lakhs, the landowner will get ITC of it. So the amount to be paid in cash is only 17 lakh 50,000 by the landowner to the government. Is the second part now clear? Perfect. I know it's like little dry subject and sometimes the concept may go over the head, but I'll try. It's like at least I've completed 70-80% of today's discussion. So we will now go pretty simple, easy, simpler things. Now we understood area sharing, revenue sharing. If I have to summarize in the whole project, everything constructed by the builder, he has to pay GST, which is retained by him, which is given to landowner. Retained by him, if he's selling before OC, forward charge 5%. If he's selling after OC, which means unsold, he is paying development right charges and the reverse charge. Given to the landowner, he is paying construction services. So for the entire units, the developer has to pay. Look at landowner position. Whatever the units landowner has got, unsold unit, he will be reversing ITC. There is no liability. But if the units are sold, then the GST is payable under forward charge, but he avails ITC. He will only be paying the incremental. And the development right which is given, this is under RCM. For landowner, there is no tax on this transaction. So this is how the GST is applicable. Now we will. Yes, ma'am. Someone is saying something. All right. Now we will move to the last part. There are mixed projects. Project can be purely commercial. Project can be purely residential, affordable housing. Project can be purely residential other than affordable housing. Or a mix of it. Today, if you see every high-rise building, the high-rise building, the ground floor is left for commercial. It could be a dispensary, a provision shop, it could be some multi-utility for the inside inmates. It could be anything. Now, the government said, if it is a mixed project, and the commercial portion is less than 15%, the carpet area of the commercial portion is less than 15%, the commercial will be treated as residential. The commercial will be treated as residential. If the carpet area of the commercial portion is less than 15%, so the project will be treated as a residential project. If the commercial portion is more than 15%, so it could be any combination. It could be 70% commercial, 30% residential, 30% commercial, 70% residential. It could be anything. If the commercial is more than 15%, then the original rate of tax would be applicable. What are the original rate of tax? We have seen the different rates for the residential affordable 1%, residential other than affordable 5%, the commercial 12%. So for each unit that is sold. So in an apartment with 100 units, 40 units could be affordable housing. 25 units, let's say 25 units be other than affordable. So 40 units are taxed at 1%. 25 units are taxed at 5%. 35 units, let's say commercial, are taxed at 12% or 18%. So the multiple rate of tax is applicable in a project. So that is what we are looking at. It's a mixed project. So the moment it becomes mixed in a new mixed project, so the commercial portion 12%, but for the commercial input tax is eligible for the builder. Builder is eligible for input tax credit. For the first two piece, you can see no ITC. For the last one, ITC is available. Okay. To qualify something as a commercial, the carpet area should be more than 15%. If the carpet area is less than 15%, that commercial is also treated as residential. Now, how do I know which is commercial, which is not commercial? In the RERA application, if you see, in the application that you are giving in the RERA, this is a sample, the sanction agreement which I have seen and which I have taken from the RERA. So you will say proposed residential development, the site area in square meters, civic amenity, and finally, what is the achieved floor area ratio is 47,000 square meters. And you can see the proposed commercial, the achieved floor area is 79,000 square feet. So here the commercial is 63%, residential is 37%. So in this project, for the commercial, you will pay 12%. For the residential, I'm presuming is other than affordable, you will be paying at 5%. So this is how you have to split from the project. What is commercial? How much commercial? Carpet area is what you will have to look at it. This is how you will be looking at the carpet area allocation segregation, and you will be paying GST. What does the carpet area means? The carpet area is net usable floor area. So it would include the internal partition, but it would exclude outside balcony, veranda, shaft area, anything open to terrace, anything which is with the external area, it will be excluded. So your balconies and all would be excluded. So that is why if you see some of the houses, like where your area is less, the achievable area is less, people create a balcony, bigger balcony, and leave it. After the house is constructed and people move in, they allow the resident to break the wall, or they don't even put the wall. They will allow people to merge the balcony area into the hall area and look the area like bigger. But for the purpose of GST calculation, you will exclude that balcony area from the carpet area definition of that 60 square meters or 90 square meters. So anything which is exclusive, you will look at whether if it is open to sky. If it is open to sky, then it will not be available. So it will not be part of the carpet area. There will be a common area unsold, which is other than residential, gym, library, and everything. So people ask this question, how do I allocate it? Where do I allocate it? Again, the answer that goes back is in this agreement, in this, you will only go by the planning authority, what has been sanctioned and what you are constructing and what you are selling. So you will have to, if there is a deviation, you will have to go by actual architect certificate once the project is completed, or generally the project is designed and developed based on the architect. You will have to take that as the basis and determine the rate of tax. Are we clear on this? Ankush is asking, can you take some example of revenue sharing as well? Yeah, let's take the example of revenue sharing. Let me just go to the Excel, and this is the area share. Let me make this as revenue share. So I'm just to avoid the retyping, I am, so what I am now, what we are saying, let's say the landowner will get 40%, builder will get 60%. Now, sold before OC. Sold before OC, how much were sold? 85 units were sold before OC. After OC, let's say we have sold 15 units, right? So let us get the value. Now, for the units sold, and we are saying 40%. So if the unit sold before OC is 85 units, 85 into 1.1 is totally 94 crores. Totally 94 crores. 93.5. So of which builder is going to get 60%. The landowner is going to get 37 crores. All right. Now, which is sold after OC. After OC, I am saying the sale value of the unit is 1.2 crores. This is what is being sold. So the builder is going to get 60 paise of it. He is going to get 10.8 crores, and the landowner is going to get from 7.2 crores. So totally in this project, landowner is going to get 44 crores and builder is going to get 66 crores. Totally this project value of 1.1, this is the value they are going to get. Is this aspect clear? First, let's understand the values first, then we will come to the taxation. Is this portion of the revenues that are shared, is this clear? Can you put it as yes in the chat? Yes. So now developer has sold to the end customers. Everything has been sold by the developer. He has sold how much? 93 crore 50 lakhs. So he will be paying GST at the rate of 5%, which is 4.68 crores. Developer sold to the landowner. In this case, there is no sale to the landowner. So nothing has sold to the landowner. So no GST. Development rights given taxation. Development right taxation. Development right value is 44.6 crores. 44.6 crores. Right. Now, unsold inventory is how much is sold after OC is 15. Unsold inventory is 15. So that means the GST on the unsold is 2.7. Other thing also you have to look, the value of the unsold is 18 crores. If it is otherwise sold, the developer has to pay 90 lakhs. So that's the 90 lakhs. Now, the total liability of the developer is 4.68 crores plus 90 lakhs in this project. Which is 5.58 crores. Landowner, he has no ITC, nothing has sold. Nothing he has sold before OC, nothing for landowner. There is nothing for landowner. No ITC reversal, no liability. There is nothing landowner needs to do. Hence, it's only the revenue share, the liability is of developer. So the developer would be paying 5.58 crores. If you look at it in an area share, here 5.53 crores, more or less is the same. Here 5.58 crores, more or less is the same. Now for the project value, that's what, so it's like just a change in the methodology and change in taxation. In a landowner, he has no hassle. In a revenue share, landowner has no hassle, no GST registration, no ITs. लफड़ा कुछ नहीं है, आराम से है उसका जिंदगी. This is also some, that is why many big builders, reputed builders, they don't get into an area share, they get into a revenue share arrangements. All right. So from the taxation perspective, both are like one and the same. Is this clear? Anyone, any doubts? Is the revenue sharing clear? Given that we did area sharing, it was like just a cakewalk. We just put some numbers. How 2.7 crores has come? Where is 2.7 crores? Okay, this is the GST you are talking. The development right value, which is this landowner value, is 44 crores. For the 44 crores has to be allocated in the ratio of sold before OC and unsold. Remember, even in the revenue share, let me just go back. Even in revenue share, we said the development right taxation is applicable only on the unsold piece. Only on the unsold piece. So in this examples, the unsold piece is 15 units. So 15 units sale value is 44 crores, and the allocated 44 over 15 divided by 100. 44 over 15 divided by 100 is 44 into 18% into 15 divided by 100. Yeah, sorry, it is 1.2 crores. Or the unsold is unsold value of the unsold is 18 crores. 5%, whichever is lower. The lower is 1.9. That is how it will be coming. So is this clear now, Yankushi? Can't we take 40% of 15 units? No, 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 because the responsibility to sell is only on the developer. So now if you see in this example, all the units, you can see that diagram on the top, both landowner units, developer units, all the units are his thing. That means whatever 100 units, responsibility is of the developer. So you only have to take 15. Yeah. All right. So we have come to the end. We have seen this. Good. Yeah, I promised to ma'am that around 5:30, 5:40 we will complete, so that we will leave more time for questions, and bang on time. Such a good, lovely, wonderful participants. You've been interacting with for all my questions. Floor is open. Now you can ask any question on whatever we have discussed and whatever is not discussed. It's over to you. And we have our own GST updates channel. If you are someone wants to know about GST, of course, this is other than real estate, all GST updates. You can always subscribe to the channel so that you will get the updates about GST. With this, I thank the Naredco Mahi team for organizing such a kind of in-depth session, and my salute to all the members of this group who are part of the one of the construction industry, one of the challenging industry, and I respect your interest in pursuing your career in this industry. On this note, I hand over the proceedings to the host for the Q&A and other aspects. So
Manasvi, you can continue.
Yes, sir. So there are a few questions that I've received. I'll go with the first one. What is the anti-profiteering mechanism under GST?
Someone wanted to see the sheet, so I put it where is this the sheet? Which when you say next sheet, which one, Yankushi? Last one में क्या है? Sheet 4 में कुछ नहीं है. We are in the revenue sharing sheet only. You can see. Yeah. So question is on anti-profiteering. See, anti-profiteering was a concept. It was there on the launch of GST. Now it is no longer there. Now, what do you mean by anti-profiteering? See, prior to the GST, builders were paying service tax, builders were paying VAT. They were not getting any input tax credit. But now when they moved to the GST, builders were getting input tax credit. So builders are benefited by moving to the GST. Government said, section 140, subsection 2, this says you cannot retain the profit, you have to transfer the profit. If the gain because of GST, you can't gain, it has to be passed on to the customers. If you have not passed on to the customer, section 171 of the GST Act says that you will be subjected to anti-profiteering. You will have to transfer these funds to the consumer welfare fund. That is about anti-profiteering.
Thank you, sir. There's one more question. How to calculate RCM liability under 80-20 rule?
Very important thing. Yeah, I forgot to tell you. Good that someone has reminded. So look at it. We've been saying that developer has to buy goods, sell at 5%, but no ITC. Now, the moment we say that there is no ITC, government want to also ensure some safeguard measures. The developer doesn't get into unregistered purchases. The government said, in the current example, we have sold the everything for, let's say, 100 and let's go back to this example. We sold this for 111 crores and the developer has got 93 crores. Let's assume that developer has incurred a cost of 75 crores. Developer has incurred a cost of, let's say, 75 crores to build this project. So what is the profit he made? He made 93 minus 75 crores. But the government said that, look, 75 crores you should be buying from the registered dealers. They said registered dealers should be minimum 80% of it. Out of 75 crores cost, purchase from registered dealer should be 60 crores. The government said that you have purchased around 75 crores. Minimum purchase from the registered dealer, expected minimum purchase from the registered dealer is 60 crores. But my GST purchases, let's say my GST purchases are 52 crores. That means there is a shortfall of 8 crores. There's a shortfall of 8 crores. So on this shortfall of 8 crores, GST is expected to be paid at 18%. So the government wants the builder has to pay, apart from this 5.58 crores, builder has to pay 1.44 crores for violating the norm of buying from a registered dealer. Since you have not bought from the registered dealer, at least 80% you have to buy. Out of 75, I was expecting 60 to buy. You only bought 52 crores from the registered dealer. So for the 8 crores you purchased from an unregistered dealer, please pay tax at 1.54 crores. This is what a 80-20 rule is.
Thank you, sir. Coming to the next question, is corporate guarantee a related party transaction and who are the related persons?
So the corporate guarantee is a new entity, a new question that has come in, wherein in a corporate guarantee, most of the time builders do not get, let's say, lending. So the parent company will say that it's okay, go ahead and give the loan to them. In case they default, I will pay. Now, the parent company has given a word. They did not charge anything from the subsidiary. Even though they did not collect anything from the subsidiary, 1% of the loan value has to be treated as if is a consideration given by the subsidiary to the parent for giving the guarantee. On the 1%, 18% GST has to be paid by the parent. That's a corporate guarantee taxation which has recently introduced. And there is a question from Gaurav Goyalji on specific treatment for purchase cement. For in this 80-20 rule, there's one exception for capital goods and cement. It doesn't fall under 80-20 rule. The expectation is this capital goods and cement, you have to procure 100% from a registered dealer because the rate of tax for cement is 28%. So let's say if you have purchased out of total project, 5 crores is cement, 4 crore 80 lakhs is from registered dealer, 20 lakhs is from unregistered dealer. For the 20 lakh unregistered dealer, you will have to pay at the rate of 28% from your hand. Hope this answers your question, Gauravji.
Moving on to the last question, how to identify non-genuine vendors under GST? And this is for material purchase and work order.
Okay, so there's nothing called non-genuine vendors, but let me. I'm just taking you to the GST government website, and you can go to search taxpayer, search by GST number. Let me enter my GST number. So this is my firms. First and foremost, you have to check what is the GSTN status, whether it is active or not active. If it is not active, that means this person is no longer in the business. Yeah. Second, you will have to see what is the filing. What is the filing table? You can ask for the filing table. For the financial year 23-24, let me just searching. You can see GSTR1, I have to file by 11th. Yes, he is filing by 11th. GSTR3B has to be paid by 20th. Okay, he's paying. So he is like a diligent vendor. So you can go ahead.
2024.
Yeah, you can kind of go ahead and look at it. At least is it active? Are they filing the taxes, everything regularly? That can be a norm that you can consider.
Thank you, sir. I'll quickly check the chat box. Yeah, there's a question from Mr. Ambuj. In a situation where value of house is more than 2 CR, tax would be 5% of basic, and how much would be on car parking and PLC?
So if the value of the house is more than 2 crores, firstly, it is 5% profit. Now, car parking, PLC, I have been telling from the beginning, it should be included. Let's say you're collecting 5 lakhs for car parking, for preferential location charges as another 5 lakhs. For the 2.1 crores, you will be paying 5%.
I guess that's all. There are no more questions. Firstly, good evening to everyone. I'm Manasvi, and it is my privilege to extend a vote of thanks on behalf of the entire Naredko Mahi team for today's enlightening session on the basics of GST in real estate. Today's session has been incredibly informative and engaging. GST is a complex topic, especially in the context of real estate, but our esteemed speaker, Venugopal sir, has managed to break it down in a way that is both understandable and practical. His use of real-life examples to illustrate the various concepts of GST has been nothing short of amazing, making the subject much more accessible and relatable to all of us. Our entire Mahi team is extremely grateful to you, sir, for sharing your expertise and insights with us. This session stands out as one of the most useful and engaging sessions in our skilling series. Your practical approach and the examples you provided have truly made a lasting impact. I would like to thank you, sir, again for your time, effort, and dedication. Your contribution to our skilling series is deeply appreciated, and we look forward to more such enriching sessions in the future. Thank you.
Thank you, and my privilege to be part of your team. I'm happy your knowledge got enhanced.
Thank you, sir.